Hello, and welcome to this beginner's guide to understanding the share market. In our day-to-day lives, we often hear about the ups and downs of the stock market on the news. But have you ever wondered what it all means? Or better yet, how you can benefit from it? The share market, in essence, is a marketplace for buying and selling pieces of publicly traded companies. Understanding it is key to making informed investment decisions that can potentially lead to financial growth. In this video, we'll take you on a step-by-step journey to unravel the intricacies of the share market. From understanding the basics to diving into fundamental concepts, getting started with your first investment, and even managing risks, we've got it all covered. So whether you're a novice investor or simply curious about the world of finance, this guide is for you. So buckle up and get ready to demystify the share market. First things first, let's delve into the basics. To begin, we need to understand what a share is. In simple terms, a share represents a unit of ownership in a company. When you buy a share, you're buying a piece of that company. And as a shareholder, you stand to gain from the company's success in the form of dividends or an increase in the share price. But remember, the flip side is also true. If the company doesn't perform well, the value of your share might decrease. Now let's take a step back and look at the bigger picture, the stock market. This is the marketplace where buyers and sellers trade shares. It plays a crucial role in the economy by helping companies raise capital for growth and expansion. It's also a barometer of economic health, with stock prices generally rising in a growing economy and falling in a recession. Now you might be wondering how stocks compare to other investment options. Well, stocks, bonds, and mutual funds are all ways to invest your money, but they come with different levels of risk and potential returns. Stocks offer the potential for high returns but carry more risk, as their value can fluctuate significantly. Bonds are essentially loans you give to companies or governments, and they're considered safer than stocks, providing steady income but lower potential returns. Mutual funds, on the other hand, are a basket of different investments, offering diversification and professional management, making them a good choice for beginners. It's important to note that no one investment option is inherently better than the other. It all depends on your financial goals, risk tolerance, and investment time frame. Some investors might prefer the higher potential returns of stocks, while others might opt for the safety and steady income of bonds. Grasping these basic concepts will lay a strong foundation for your investment journey. Remember, knowledge is power, especially in the world of investing. So keep learning, stay curious, and you'll be well on your way to navigating the share market with confidence. Now that you understand the basics, it's time to get started. The first step on your investment journey is researching and selecting a brokerage platform. This platform will be your gateway to the share market, so it's important to choose one that suits your needs and comfort level. Look for user-friendly interfaces, access to market information, and reasonable fees. Next, you'll need to open a brokerage account. This process is usually straightforward and involves providing some personal information and setting up a way to fund the account. Once your account is set up, it's time to dive into the different types of orders. You'll encounter terms like market order, limit order, and stop order. A market order is a request to buy or sell a stock at the current market price. A limit order, on the other hand, is a request to buy or sell a stock at a specific price or better. Lastly, a stop order is a request to buy or sell a stock once it reaches a particular price. Remember, every successful investor was once a beginner, just like you. Now let's dive a bit deeper into some fundamental concepts. First up is market capitalization. It's a fancy term, but it simply refers to the total value of all a company's shares of stock. You calculate it by multiplying the company's total shares by the current share price. Market capitalization gives you an idea of the size of a company and can help you assess the risk or volatility involved. Typically, larger companies are considered more stable, while smaller companies may have more growth potential but also more risk. Next, we have the price-to-earnings ratio, or the PE ratio. This is a valuation ratio, calculated by dividing the market value per share by the earnings per share. It's a way to compare the relative value of companies, essentially telling you how much investors are willing to pay per dollar of earnings. A high PE ratio could indicate that the stock's price is high relative to earnings, and possibly overvalued. Conversely, a low PE might indicate that the current stock price is low relative to earnings, potentially making it an attractive investment. Finally, let's talk about dividend yield. This is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. The dividend yield is calculated by dividing the annual dividend payment by the market price per share. It's a measure of income from an investment. A high dividend yield can be particularly attractive to income-focused investors, as it provides a stream of income in addition to any potential capital gains. So, to recap, market capitalization provides an estimate of corporate size, the P/E ratio gives you a comparative tool for assessing value, and the dividend yield offers an insight into the income-generating potential of a stock. These are some of the key metrics investors use to evaluate stocks. Investing is not without risks, but these risks can be managed. Just as a tightrope walker uses a balance pole to maintain stability, investors use a variety of strategies to manage the inherent risks of the share market. One of the most effective strategies is diversification. Diversification is a bit like not putting all your eggs in one basket. Instead of investing all your money in a single stock, you spread your investments across different sectors and asset classes. This way, if one investment doesn't perform well, the others may help offset the loss. Think of it as a safety net that can help soften the fall if things go south. Now let's talk about volatility. In the share market, volatility refers to the speed and magnitude at which the price of an investment increases or decreases. It's a measure of risk and uncertainty. A highly volatile stock may have large price swings, which can be nerve-wracking for investors. But understanding volatility can help you make more informed decisions and potentially take advantage of these price swings. Finally, setting realistic investment goals and defining your risk tolerance levels are vital. Your investment goals should align with your financial objectives, whether it's saving for retirement, buying a house, or funding your child's education. And your risk tolerance level determines how much risk you're comfortable taking on. It's influenced by factors like your financial situation, age, and personality. For example, if you're a young investor with a stable income, you might be willing to take on more risk for the potential of higher returns. But if you're nearing retirement, you might prefer safer, less volatile investments to protect your nest egg. It's essential to reassess your investment goals and risk tolerance periodically, especially when your financial situation changes. This way, you can adjust your investment strategy accordingly and stay on track to meet your financial objectives. Remember, risk management is a crucial part of investing. It helps you navigate the ups and downs of the share market, making your investment journey smoother and less stressful. So, keep these strategies in mind as you embark on your share market adventure. Now let's talk about how to analyze stocks. Two popular approaches are technical analysis and fundamental analysis. Technical analysis involves studying price patterns, volume, and trends to predict future price movements. Think of it like the weather forecast. It's all about patterns and trends. On the other hand, fundamental analysis is about evaluating a company's overall health. It's like a doctor's checkup, but for companies. You'll scrutinize financial statements, assess the company's growth prospects, and examine its competitive position in the industry. Key indicators include earnings, revenue, and cash flow, among others. Remember, it's not about choosing one over the other. In fact, many successful investors use a combination of both. They use technical analysis to decide when to buy or sell a stock, and fundamental analysis to determine which stock to buy or sell. Using both these approaches can help you make informed investment decisions. Well, that's a wrap on our beginner's guide to the share market. We've covered a lot of ground today, from understanding what a share is to the role of the stock market in our economy. We've discussed how to get started by choosing a brokerage platform and explored important concepts like market capitalization, price-to-earnings ratio, and dividend yield. We also dove into risk management strategies, including diversification and understanding volatility. And let's not forget about analyzing stocks through technical and fundamental analysis. Remember, this knowledge is your first step into the world of investing. It might seem overwhelming at first, but with patience and consistent learning, you will master these concepts. We encourage you to take the first step in your investment journey. Join us for more informative content and in-depth discussions on investing. Remember, the journey of 1,000 miles begins with a single step. Start your investment journey today.